Hopefully you've had food and food is no longer on your mind, so you can pay attention to our fantastic panel today. I'm Gita, Johar. I'm a professor at Columbia Business School and also the Senior Vice Dean. And it's a real pleasure to be here because this is a topic that's very close to my heart. I've designed courses around issues of innovation, entrepreneurship, social enterprise, and I'm also very interested in the research in this area. I thought what we'd do today is start by maybe transitioning from the keynote to this panel by asking the question, what is it that financial institutions can do given the realities on the ground, given the issues of bandwidth problems or depletion or what you might call them? And in order to surmount these issues, it's not just a question of giving financial products that serve this market, but it's really a question of designing the right financial products. So that's an issue I thought we'd start with. So maybe I'll ask our panelists to introduce themselves and then address this question of what are the implications of that keynote address, of the research that Sendil and his co-authors have done on design of financial products. So let me turn to Tony.
Thank you. I'm Tony Goland from McKinsey & Company, and I lead our global financial inclusion practice.
Hi, I'm Keisha Cash, formerly of JaliaVentures, Director of Impact America Fund.
Hi, my name is Erick Brimen. I'm a COO of CoFoundersLab and a founder of a few subject matter companies such as Compara Mejor in Latin America.
Thank you. So let me turn to that first question that I raised, and feel free to speak in any order. So what do you think are the implications of these findings on scarcity, on bandwidth issues for design of financial products to serve that market?
Well, I found it extremely interesting, using different language or words and not as thoroughly investigated. I suspected the same thing based on observations. And my observation was basically much more basic, saying you cannot have entrepreneurship happening in a country and individuals pursuing objective of higher order when they're hungry and they're trying to feed themselves and worry about the most basic of needs. And we've all seen those pyramids of needs. And so in conclusion, I think it's spot on, and it begs the question: if you cannot pursue higher order objectives until your basic needs are served, then how do you try to serve those basic needs for the largest amount of people in the most effective and efficient way? So I think it's spot on, and it's one of the big challenges of our time.
Okay, thank you. Keisha?
Yeah, I completely agree. I grew up low income and faced many of the bandwidth challenges, and family members currently face those challenges. And the things that they think about and worry about, top of mind, are money related. So I completely agree, and I think through our work, our goal is to spur entrepreneurship in the community by providing those financial resources. But with that also comes a behavioral shift and a mind change as to what this now means, now that I actually have ample resources. So when we think about financial inclusion from an early stage standpoint, in addition to capital, what are the behavioral changes that need to happen to assist with that capital?
Thank you. Tony.
So one observation from a financial services standpoint is that people have a range of needs. Everyone has the same range of needs for transactions and credit and savings and insurance. And so it is inevitable that you will need a multi-product offering. And to some extent, a single product model is not going to be the solution. Within that, on credit, it is very inefficient to do small loans one at a time. So the solution to that is to have a line of credit. And so figuring out how to do the credit risk management and to provide low dollar unsecured credit that people can use to manage the spikes up and down in their cash flows. We all take that for granted, but in the US, until 40 years ago, only wealthy people had access to unsecured credit through the introduction of the Bank of America card, which became the Visa network, and the general purpose credit card industry. The middle class of America now enjoys unfettered access to unsecured credit. So how can we bring that capability to the 2.5 billion people around the world that don't have access to formal financial services?
And if I may add just a comment to that, which I think is absolutely true, something I've also realized is that it's very hard from a single point of view, especially, and I'm not saying, Tony, this is the case with you, of course, but I think it's really hard to come up with a product or a variation thereof that suits every locality's needs, every individual market. So I think the beauty and part of entrepreneurship is that if you empower individuals who are living the problems, then they can come up with a solution that best suits their needs. And certainly when it comes to financial products, there's a very institutionalized series of factors that come into play, as in where does the capital come from and how do you manage risk, etc. But the way in which you deploy that capital and access the people who can make the best use of it, I think that there's a world of innovation and many, many examples that we might all be familiar with. And those came from the bottom up. Hardly ever do those pioneering innovations came from Wall Street or the developed world for that matter. Usually they come from the developing world with innovators on the ground understanding what the real needs are.
That's a very interesting observation, Eric, because there's a lot of talk these days about reverse innovation, that these kinds of innovative products really come about, like you said, from the bottom up in emerging markets and other places, and these are then adopted maybe by the developed countries. I think Sendil talked about the fact that time pressure leads to that moment of true insight, given you ruminate for a while on a number of solutions. So constraints can actually create some kind of innovative solutions that are then adopted. So I think that's very interesting. Tony, you talked about multi-product lines. That's really the solution. Can you give some examples maybe of where this has been done and it's been successful?
Well, I think in general it's still early days on financial inclusion. And the major innovation, as everyone knows, has been microfinance and the group lending model. When you look ahead and you look at the cost of the interaction, it is inevitable that the multi-product approach will have to be developed. So if you look at something like a McDonald's and the value meal, from an economic standpoint, it's much harder to sell individual elements of that versus the bundles. And so we see that in the mass market of retail banking, that you create bundles that anticipate the needs of different customers, and of course everything lends itself to a segmentation. The benefit of that is then whoever it is that's interacting with the customer gets away from trying to sell a product and gets into understanding what are the needs of the customer so that I can do the pattern recognition and check them and match them up with the bundle that makes the sense. One of the best examples of that is actually what Wells Fargo does in the core of its retail banking. And they really have been the most successful and have more products per customer basically than any other bank. That will be very challenging to replicate that in financial inclusion, but the concept is the right one. And if you've read Portfolios of the Poor by Jonathan Murdoch, it's clear that people do have the range of needs. So if your objective function is to achieve full financial inclusion, you want to get beyond selling a product, no matter how much it's needed, and get into solutions that solve the customer needs, and think about it as a journey over a period of time. We always talk a lot about the supply side, but on the demand side, we have to help people develop the knowledge and the capability to make better decisions. So the journey of working with the customer in kind of a two-way approach over a period of time to bring them the products and services that they need at affordable prices and to help them along so that they can get the benefit of what's being made available to them. That is very different from a model that is pushing a product.
And I would add to that model and what we're seeing in the impact investment space requires patience, it requires time, and there's an additional capital commitment that's needed for the education piece of that. So oftentimes we talk about innovation and we talk about rolling out affordable products and services, and my question is who will pay for the education that's required to couple with this innovative product? And there's a company that I know of that my larger sort of parent investment fund is invested in, Emerge Financial Wellness, and they're working with corporations to provide essentially alternative to payday lending, and they work with the employees as well as the corporation to provide educational training. So you're not just given a loan, but you're also required to take certain tests to make sure that you truly understand what this means, and also encouraged to save that money. So I think innovation is great, and we also have to really think about the cost associated with that education.
This is really resonates with me because I'm a marketing professor. We'd like to think we focus on consumers, and that's the most important part of the puzzle. But clearly, all of these issues are important. Why is it that this hasn't happened so far? Why is it that we're still talking about it today, and key players haven't stepped in and kind of understood this notion of multiple products and really stepped into the space? Erick?
In this country, there's, 60 million, I think, unbanked or underbanked individuals. We had a side conversation earlier, and Anthony mentioned the need for data and information. So it's not an easy thing to do, and it will take time, and there's cost associated with it, and you will not make money right away. It's a volume game. So I think we haven't seen players step in because it's not, initially it will not be a profitable business model.
It's a very hard question to answer. I think that it's easy to see what we haven't done yet, but I think there's been tremendous advances for sure if we look at the past 10 years, not only in the developed worlds, but in the developing economies. And it's a matter of how can we make it happen faster, as opposed to how come nothing has happened. And I think you're right, it's hard. A lot of these decisions involved risk-reward analysis, as every other investment decision, whether you're providing debt or equity. And in order to have a better grasp of what the risk is, you need more data. And I think we're at a great time because with enabling factors such as technology, we have greater access than ever before to individuals that we might have not even been able to reach without driving to a village. Now they have a mobile phone. Now you can not only get to them, but they can respond, and you can, to some extent, build that data that will facilitate the risk models and therefore the flow of capital to those otherwise unserved areas. So I'm extremely excited about how and where we stand today, thanks to technology to a great extent. I think another area that often doesn't get as much attention, but deserves just as much, if not more, is the regulatory environment. And ultimately, that risk-reward equation is not just do you understand the risk from a fundamental basis, but what hoops do you have to jump through to get the money in and then get it out. And not to mention, the exchange rate risks and the instability that a particular economy might have. So I think the regulatory frameworks in place and how they are there to facilitate flows of capital versus inherently make it harder and therefore hurt those who need the access the most is a question worth a look with a very honest and objective approach.
We think of financial inclusion as a market failure. So there's clear evidence of demand, there's a capacity to pay, but the supply has not developed. And so why is that? Financial services as an industry is highly regulated and perhaps among the most regulated of any industry. So that really tends to slow down the ability to innovate. And it's on both sides. So the incumbent institutions are really focused on more affluent people, mass affluent and affluent. They don't really understand lower income people, and they do not have business models that are cost effective in serving lower income people. So all the exhortation is really not good effort because they literally can't do it. And as institutions, they're much more focused on safety and soundness and regulatory compliance. By nature, they're not the most innovative. So even though they are the best positioned to do it, they are probably least likely to do it. Then on the other hand, the regulator, looks a lot like the institution. What are they focused on? Safety and soundness, regulatory compliance. They're not in the business of encouraging innovation and putting the conditions in place in which earlier stage investors can come up with new business models. So it's very slow going. So despite all that, I think we are encouraged by all the evidence around the world of the progress that is being made. And I would like to believe that we're really at an inflection point on this, and that everything that is necessary to achieve full financial inclusion is really on the table. And what's going to be needed is in each country or within a large state or province within a country is who's going to put those pieces together. Because it's really kind of an ecosystem in terms of distribution and technology and products and so forth. No one institution is going to be able to deliver all that because it's too expensive. So who's going to stand in the middle and put this ecosystem together to really solve the problem? So that's kind of where we are, and I think high hopes for the next 5 or 10 years that will make a tremendous amount of progress and perhaps make sufficient progress along the idea that in this element of poverty eradication that perhaps in the next 10 or 20 years we can get 80% of the way there.
And if I may add to that, I think absolutely right, the big institutions are the best positioned, and yet they're not the ones doing it, and to some extent the least likely. I think this probably has something to do with the relativity of, again, risk and reward. But if you think a huge bank, a Citigroup or any of the other large banks in the world, they have, to look at the overall set of opportunities, and they have to decide how to invest their resources and what's going to give them the biggest return. And if you think about providing a loan to an individual that's going to borrow $10,000 to buy a car, and then the return you can get on that investment versus trying to provide loans to 10,000 people to also deploy, the same amount of capital, the effort associated with doing that is tremendous. And I think aside from big institutions in relative terms seemingly having less of an incentive, there's also, so then you ask, well, why do the smaller players don't do that? Because, okay, they might not be as capable, but in relative terms, they ought to have the incentive. Well, there's a pricing issue that I think to a great extent they get priced out of the market if they're going to go through the traditional formal financial infrastructure because of regulation to a great extent, because of the complexities associated with complying versus, being able to do it on a more individualized basis. And I know we're going to talk about this later, why to some extent crowdfunding is very exciting because it allows a whole different source of capital to reach, that supply and for the supply to reach the demand in a way that bypasses to a great extent as far as the regulatory environment permits it, all those issues that big institutions have to deal with.
So we see technology as an enabler and regulations as kind of a hurdle. So maybe we can talk about those 2 points a little bit. Specifically on regulations, everyone says it's the regulatory environment. So if you had your, if you were the regulator, what would you do to make some of these things easier to do, to build models that would actually serve the poor and lead to financial inclusion? What would be the 1 or 2 things you might do differently? Let's talk about the US.
Well, for one, if you think about the banking sector, it's extremely hard to be able to engage as a bank, from licensing to getting the charter to complying with certain requirements. And I think that might be appropriate for systemically relevant institutions where if they fail, everyone suffers. But the smaller institutions, the entrepreneurs out there that are eager to supply capital and take risk, you're pricing them out. So, I'm not an expert in terms of what the regulation ought to say, but I know what it ought to do is that it should certainly make it easier for people who want to engage and compete and provide capital to be able to do so. And I just find it extremely hard right now based on the little that I do know.
Yeah, so I don't think you want to weaken protections, right? So I don't know that it's about changing regulation as much as it is the mindset of the regulator of what problem is it that we're trying to solve. So right now, around the world, regulators are more in a mode of punishing evildoers, which is not a bad thing to do, but is really the smaller part of the problem. And as we were talking about just briefly before the panel, the unintended consequence of that is actually to make it worse in that people pull back and that poor people have even less access to the products and services that they need, and it does push them into the highest cost alternative. So the idea that the regulator would encourage and enable the innovation and investment to figure this out is very important. And there are examples around the world of where people have done that very successfully. So, for example, in Brazil, where they have the government transfer payments are distributed through the ATM. And they basically just said, everyone has to access the ATM. They can do that because they're primarily an urban population. But then there was some very creative problem solving to say, well, if we're going to give people a stream of transfer payments that we know they're going to get electronically and we've minimized the fraud, that we can let the banks use the future stream of payments, at least in part, as collateral to reduce the cost of lending. And so there's a great example, and that has worked tremendously well. There's a great example where you're getting collaboration between the regulator and the industry to help go beyond the bad behavior and to actually make progress on solving the market failure. So I think it's more adopting that mindset and collaborating with the industry to solve the problems.
Keisha, you're in the thick of this, so what are your thoughts?
Yeah, I honestly, we're investing in early stage companies. There's an area of focus, big data for good. And there's a company that we're invested in that actually provides, not to go off topic, but lower cost communication services to inmates. And what we're seeing is through this model, this company is collecting data, not only the data that they're aggregating, collecting on inmates, but also on the friends and family members, which are low and moderate income community members. And it's interesting to take a look at this data, as you mentioned before, and think about other products and services that can essentially be distributed through this technology model to reach low and moderate income communities. And we're thinking about financial products, prepaid debit cards that actually don't take advantage of the vulnerability of this community, but enhances encouraging savings. Are there, educational products, et cetera? So I completely agree. I think we're at the sort of tip of the iceberg here in the very early stages of folks on the ground, to your point, innovators in the community who understand the community, that are trusted by the community to actually collect this data and then leverage this data and use it in a way that's actually beneficial for the community. My biggest fear is that we go down this data path and it gets in the hands of those who continue to abuse and take advantage of people that aren't in a position to make decisions regarding options that are beneficial for them.
I'd like to build on that because I think our view is that the use of data from that's generated from electronic devices is going to be the most important factor in eradicating poverty. Anonymity is not the friend of poor people. So if we don't know you, we can't serve you. We don't know what your needs are. We don't know what your ability to pay is. We can't manage the risk. And because of the low revenue potential per customer, we cannot afford to create that information. So while the proliferation of electronic devices in and of itself is a huge boon, as people increasingly use those devices, they create information which we should think of as assets for poor people. So they're creating data that has value. And so we're looking for the business models that work with that information and help people share in the benefit of the data that they're creating, and that there's a sharing of that benefit both in terms of the customer and in terms of the provider, again with this kind of longer term view. That I think is really going to be the game changer. So we're very excited about the potential of this non-traditional data to help close the gap, not just in financial services, but on a range of social issues.
So, Erick, you brought up the notion of crowdfunding earlier, so maybe we can spend a few minutes talking about that. What do you see as the role of crowdfunding in serving the goal of financial inclusion?
Sure. Well, I mean, there's so much to say about crowdfunding. I think at its core, it's clearly democratizing the flow of capital, certainly bridging the gap or bringing the supply of capital closer to the demand on a peer-to-peer basis, ultimately harnessing technologies that are now available that weren't 10 years ago, such as social media and the higher internet penetration. But I hope I'm not going to be saying something too basic. Ultimately, crowdfunding is technology-enabled, peer-to-peer, either lending or providing capital in exchange for rewards or for equity. And I think the promise of of this model is to level the playing field to a great extent and to let the relative value of a small loan and a small return on that investment take hold of people who for themselves it would make sense, and therefore they'll engage in that transaction, whereas for a larger institution it might not. So I think there's tremendous promise, and before I say a few things, I got a lot I could. I'll just let the rest of the panel also comment on it.
Okay. Keisha?
Crowdfunding, I think it has great potential on a local level, in that you have to know people that you're doing business with in any case. So I think this notion of me investing in, a supermarket being built in California, doesn't make sense. But if the supermarket is in my neighborhood and I know the supermarket owners and I know my neighbors and I can physically see that supermarket, then that makes sense. So, I'm a conspiracy theorist at times, and we just have to be really careful with products and services that offer the individual this opportunity to invest and potentially make money on that investment. We saw that happened in the housing crisis. So just that the protection needs to be in place so that people are making very smart and wise decisions.
I would just broaden the idea from a social networking standpoint, that to bring people together to help each other, I think, is a very powerful idea. Providing capital, I think, is one big element of it. But also when we think about the task on increasing knowledge and building capabilities, and your point of who funds that, to the extent that we can actually bring people together to help each other and share their experiences and their knowledge with each other, that potential is there. And so I think you'll achieve that kind of that demand part of it by using technology, whether it's massive online courses, e-learning, interactive text messaging, help people understand when they make their payments that they can earn a lower rate or they can get a bigger line. So using all that technology to reduce the cost of delivering financial education and literacy. I think that's a very powerful idea, and that will be part of one of these business models where we're really focusing on the customer and we're in it for the long term. We're not just trying to push some product out, and we create this kind of value that they provide to each other.
So I think what I'm hearing is it's not just about financing, it's about much more than that. It's building the ecosystem, as you said earlier, Tony. So let me switch gears a little bit before I open up to the audience. I want to talk about the role of universities, business schools, and the research that we can do that can help inform this problem. So what do you think are some questions that we should be really looking at in our research?
That's a great question. I'm actually engaged in a project right now with Columbia School of International Public Affairs, and I have some grad students, I believe, that are here in the audience. And that research project is to think about the mission management of the companies that we invest in. So we are impact investors, not only looking for a financial return, but really looking to solve some of these big problems. And that task, or what they've been tasked with, is to think about the cost associated with that mission management portion of the company, and how do we ensure that as this company grows in scale, we are still, first and foremost, looking to address that social problem. So that, and I'm thankful for the opportunity to collaborate with a university who's thinking about these issues. So for me, I'd love to see more collaboration between the work that I do and the business sector in general with very tactical research projects.
Well, from my point of view, obviously, I think, let me step back. The system of entrepreneurship in the best of places here in the US, where it's the most successful, still has a very low rate of success. Depending on what measures you're using, it's certainly more than 90% of anyone who tries fails. And so when we looked at this at CoFoundersLab and said, why is that? We realized that a huge portion of that has to do with the co-founders themselves, the individuals behind the businesses, not just that the market that they were pursuing or the technology that they built didn't work, but that the teams themselves eventually fell apart. And personal relationships are complex in nature, and when you put 2 or 3 individuals in a very high stress environment where there's a lot at stake, you might have put your savings in there and things are changing outside of your control, obviously that just compounds the complexity and issue. So the problem we were trying to solve, and I think it's a huge problem to solve, is how do we facilitate the formation of teams in a way that increases the odds that they will survive. Just by ensuring that they stick together, the 5 to 10 years minimum they'll have to in order for that business to begin flourishing. Just by doing that, you could deal with 30% of the reasons why a lot of businesses fail, which are co-founder related. To that extent, we've, I think, hopefully taken a pioneering role and been at it for some time, and we're doing a lot of algorithmic-based recommendations where individuals are complementary with each other based on their mission and their skill sets, etc. But I think that there's a world of opportunities out there to try to put more science to what makes a great team, because it isn't just about great individuals working together. I mean, that's obviously an important element and perhaps the most important, but you might have 3 top-notch individuals that might not necessarily make a great team. There's a lot going on below the surface, and that's what we're trying to solve. But there's a lot of science that needs to go into it. So when it comes to researching what is that, if you will, Moneyball way of approaching team formation, we're certainly doing a lot of work around it, and if any university wants to help us, we will be happy to take any help we can get.
We believe there should be a Hippocratic oath for financial inclusion, which is first, do no harm. And in that context, I think universities are in the business of education, and so helping to crack the code on how to build knowledge and capability of the customers, both individuals and smaller and micro enterprises. That field is wide open. I think there's a lot of effort, but I couldn't say that we're more than 2% of the way there, especially in terms of using technology to increase effectiveness and reduce the cost of reaching, we're really talking about billions of people. So it seems like since universities are going through that transformation themselves and learning how to adapt their own models using the most recent developments, getting the benefit of that to apply to this specific problem, to me, would be very powerful. And hopefully, we could say, again, within a decade or so, maybe we could really solve that.
Okay. So let me turn it over to the audience at this point for Q&A. I think we've heard some really interesting things that prevent and could enable financial inclusion going forward, the role of technology, the role of regulation, a lot of other things. But feel free to ask any questions of this really expert panel. Please state your name and affiliation.
Hi, I'm Patty Agmaya. I'm a CBS alum. And I had a question about, you talked about technological advances. What is your thoughts on Bitcoin and these sort of cryptocurrencies and their role in inclusion, if any?
Well, I think they certainly help bypass a lot of the hurdles that are currently in place, but I think it's still very early to tell whether these, especially Bitcoin in particular, as you've seen, just this week, there's a lot going on there. But I'm a believer that it holds great promise. If you think about it, all of a sudden, your cell phone, it's all you need in order to be included in this financial system. You don't need to open a bank account. You don't need to do a lot of the things that you used to in the past in order to access, and be able to exchange. And an earlier conversation addressed how do you change money from one country to the other. Those barriers are completely eliminated with something like Bitcoin. And it's not the only cryptocurrency, as you probably know. There are several others. Bitcoin has just been more covered by the press, and they've been around a little longer. So I'm an optimist in that regard. I think it's about time that the traditional financial system got some competition, and so I'm kind of cheering on the sides to see how this is going to evolve, but also wary that it's very risky and that individuals need to just think about what they're getting themselves into. And if you're going to go into Bitcoin, it's just, it's right now a gamble. So as long as you're aware of that and you're willing to take the risk, I think there's a lot of promise there.
Yeah. As it relates to financial inclusion, I think we're talking about a population of people that are pretty vulnerable. So I don't think exposing them to risks that they cannot possibly understand or manage individually is a good idea. So I think I would restrict that to much more sophisticated players. Same thing with individuals investing in hedge funds. And so I think what we need to bring for financial inclusion are things that are much more proven, and we need to take risk out of the equation for poor people, not introduce risk.
Hi, I'm Alex Gregory with Collaboration RX. I'm curious, I haven't heard anyone talking about credit unions, and it seems like from my experience that the primary banking system is not particularly friendly towards small entities, companies, people. The whole structure is that the less money you have, the more risk you are, therefore the more you're going to be charged. Credit unions are non-profit entities, and I'm just curious if anyone has a take on that, because I don't think I've heard them mentioned.
I think it's very consistent with this idea of the business model that seeks to help the customer benefit from the assets that they're creating. So as you're describing, whether it's a mutual or a cooperative model where any surplus flows back to the consumer, I think is actually much better suited to a financial inclusion environment. But that doesn't mean that the activity is not profitable. It has to do with the distribution of the profit. So we need to be precise about the term nonprofit. Even Muhammad Yunus agrees that the activity should be profitable because that creates accountability for results and incentive for improvement and the ability to attract talent. What he debates and what we're talking about is what happens to the distribution of the profits, and if it gets reinvested back into the consumer base, then that feels like a better fit, especially as we're talking about the vulnerability of that group and the need to work with them over a period of time to help them, achieve what they need to achieve. So I'm a big supporter of the idea of that mutual company or cooperative environment as the right structure for these kinds of business models.
Hello, Betty Wong from Intro America. I'm also a CBS alum. So I'm curious about how companies that are inclusive in terms of team makeup break through in terms of getting funding, given the profiling that we know happens among angels and VCs.
I'm sorry, could you repeat the first part of that question? How do teams?
Yes. We commonly know that angels and VCs like to invest in people like them. So if there are teams that are not exactly people like them, but have actually gone to graduate schools and have traveled the world and so on, have a corporate experience, how do they break through if we know that VCs and angels like to invest in people like them? So what happens?
Well, I'll tell you one thing. I think that what VCs and angel investors want most of all, in addition, it's not so much investing in people like them. I think it's a return on their investment. And so I think there is a lot of that perhaps going on where people who are different have less access. And to the extent that that might be true, I think platforms such as crowdfunding can definitely help that, because all of a sudden it's less about this, if you want to create an image of an old boys club of all the rich guys with money, and in these angel groups deciding where the flow happens, versus in a more democratized approach where the money can come from anywhere through this conduit. I think that will address perhaps some of those concerns. But ultimately, it has to be about the businesses being solid, the opportunities that they're pursuing being attractive, and the teams having the skill sets that are required. And that goes to building capacity, not just about making a frontal or perhaps a cosmetic change on the surface.
And I'll add to that in that there's a cultural phenomenon as well, in that if, for example, the inmate services company that we invested in, that founder is an ex-con. He spent 4 years in federal prison for trafficking marijuana. He went through a mentorship program for one of the top technology accelerators, presented to actually participate in the accelerator and was denied. In my theory, and from discussion as well, he was denied because the people around the table did not have an understanding of what it means to have a loved one in prison and what that means in terms of the cost associated with that. And so that organization now is sort of revamping who's at that table to make some of those investment decisions or decisions as to who participates in that accelerator. So there is, it's beyond sort of looking like the person, it's really understanding where that person is coming from and having a good enough sense of the target market to make a clear evaluation as whether or not this product or service is actually going to be beneficial. So that same entrepreneur goes through a minority-focused accelerator, and he comes out on the other end and he raises $1 million last July, and now is raising a Series A round that is, halfway there, and he just opened. So it's just, and we invested right away, and my business partner then and still now is a Jewish man over 50. He understood the market because he's actively involved in drug reform, et cetera. So it goes beyond, again, looking like the person, but having a deep understanding of what that market opportunity really means.
That's a very good point.
That's great.
It's great to hear success stories. Thanks, Keisha.
My name is Ellen Morris, and I'm a founder of a social enterprise working in East Africa on education, mentoring, and access to finance for small and medium-sized enterprises in East Africa. And I just had a question, maybe it goes to Tony, since you have done a lot of thinking about this, is sort of the financial inclusion as it relates to small and medium enterprises and small entrepreneurs, and thinking about access to capital and education for local entrepreneurs who maybe have a cook stove business or a solar enterprise, and looking at it's not microfinance and it's not impact investing. It's this middle financing gap that we see that requires small amounts of capital, relatively small amounts of capital, at very affordable terms for people who are really trying to move up with access to high quality education and mentoring to build and grow a business.
So that, I think, is the point about the use of the data, because group lending is a marvelous innovation, but it has its limitations, and it's very hard to scale, it's very people intensive, and there's borrower fatigue over time, and it's a proxy for the ability to do the underwriting yourself. You create a group that kind of underwrites itself. So that's where we are encouraged that as these individuals are using electronic devices in their lives, whether it's the phone or more than the phone, that capturing the information from that can be used very cost effectively for credit risk management. And so we are seeing and we are anticipating, significant growth in providers of funding using this non-traditional information really to have a breakthrough innovation in the ability to reliably manage the credit risk. And that means that it can be affordable to the micro entrepreneur. So that's, I think, the bigger element. Obviously, there's issues about distribution and collections and things like that, but in the core of the problem and the ability to understand enough about that person to be able to reliably make the decision, we see that as having the most upside potential.
Yeah, hi. Good morning. My name is Brian Blake. I'm with Springbank. We're a community development bank in the Bronx, FDIC insured, state chartered. And Tony and also Professor Johar had spoken about the role of regulation in innovation. And as a regulated financial institution, I was wondering if you had any insights into what it might take to encourage the regulatory environment to develop an encouraging attitude towards inclusion with traditional capital structures rather than the adversarial approach, which you mentioned before?
Well, if anyone knows the answer to that question, please come forward. You know, at one level, I think it's personal relationships, right? If it's very arm's length, I think it gets very challenging. So if you can build trust with the regulator, I think it's a key ingredient. Also, you know, not to be perceived as lobbying for a position, and that's very difficult. But I have a client who's in the affordable housing business, and in this country we have a new regulator, and he's working very hard to build the trust that he's providing information and advice, not lobbying for a position. So I don't think there's any silver bullet kind of solution to this, but adopting a mindset that says, hey, if I stand in the regulator's shoes, what is that person wrestling with? Really understanding what the challenges are, providing ideas and facts, and not to be self-interested about it. And then to the extent that you can get a broader set of industry participants to kind of come with that approach, I think you're then creating an environment where, you know, you might get reciprocity. And so, you know, turning the other cheek and not viewing it as a zero-sum game.
So you talked about change in regulators. In India, interestingly, the new governor of the Reserve Bank of India is an academic, a professor at the Booth School at the University of Chicago, Raghu Rajan. And he has thought very deeply on a lot of these issues, and he's now heading the Reserve Bank in India, which is leading to all kinds of interesting things, including him setting up a commission that looks exclusively at this issue of how do you bring about financial inclusion. He set up an independent commission. They've come up with a series of recommendations. A big obstacle in India, for example, is a bank needs, I think, 500 crores of rupees to be set up, which is a huge barrier. And these banks then become very stolid and not at all innovative. So what do you do to bring about innovation in the sector? So the governor, being new, being from academia, being from the US, has really come in and shaken things up, and maybe a change in regulators is one way that you can get some of these things moving. I saw a question here before, yeah.
My name is Paula Giraldo. I'm with CIPA at Columbia University. And my question is, the poor not only have to deal with the fact that they receive low income, but also with the fact that the timing of those incomes coming in are really uncertain. Yet many formal and informal MFIs, they are providing credits to, you know, for them to build their micro enterprises without realizing that not everyone is an entrepreneur. So in your view, how institutions can step up and help the poor to cope with the timing, income risk that they have?
Big question. I like to use examples of, I had a conversation with someone at Doorway to Dreams, and they are actively doing research on financial inclusion, et cetera, and there's a program that they rolled out in that if you're low and moderate income, your tax check that you receive each year is like your windfall. It's like winning the lottery. And oftentimes you've spent that check before you actually receive it. And so they've been doing pilots and studies on if they can capture people at that moment, sort of the harvest resonated with me. If they can catch people at that moment when they win the lottery, you know, can we encourage savings, and is there some sort of matching component to that? So, and the pilot showed, you know, extraordinary results in that if people actually, you know, put $500 away and they get that match, then they're more likely to save next go round when they win the lottery again at tax season. So I think, I mean, I don't know an answer to your question, but there are people actively working on capturing consumers at that point of sort of the windfall.
Well, I think the idea for, you know, a smaller enterprise of the mismatch of inflows and outflows, I don't know that you can change that reality, but what you can do is figure out how to give people a line of credit, so that they're not borrowing a specific amount every time they have a shortfall, but you're giving them a tool that helps them smooth the inflows and the outflows, And that then comes back to the underwriting challenge of, if you're going to give someone 2 or 3 or 4 weeks of cash flow in a credit line, how do you do that in a way where you don't have very high charge-off? So it comes back to more of a risk management, which gets back to the product design and so forth. So that exists in the world in lots of other places, but it hasn't been developed yet for the people that we're discussing.
Maybe I can ask a question, if you allow me. Part of what I picked up is that it's important to get money to entrepreneurs in general, and that the reasons we discussed earlier, often in areas where there's a lot of poverty, people have poor records, or they don't have the credit histories, they don't have the experience, et cetera. Keisha, you made a reference to funding someone who's an ex-convict who maybe would be screened out of normal financial markets for funding. But there's also the other side, that there's just simply not enough entrepreneurs. And this often comes up, you talk to social funds, they say, my problem is not really money, my problem is finding entrepreneurs. So I'd like to ask you, are there entrepreneurs out there in numbers, and if so, are we reaching them? And if they're not there, what should we do about this?
Well, I think, if I may, it depends on how you define an entrepreneur. And depending on how you come out on that, then the answer can be there's a lot or there's very little. If by an entrepreneur we mean somebody who's actually gone forward, taken the risks, accessed resources, and begun down the path of building a business, then for sure that's a very small portion of the population. If, however, by entrepreneurs you also include people who have the potential to be an entrepreneur because they see a problem, they wish they could solve it, but don't take the step. If you include that part of the population, I think that the numbers increase materially, and I would submit that probably most of us here in this room have at one point or another thought of a problem we wanted to solve and perhaps have the potential to be an entrepreneur. So if you include the people who have the potential as opposed to the people who actually pursue it, then it broadens the issue of supply of entrepreneurs. So then you ask, well, why is it such a small proportion of people who actually take the step? And I would agree. I think that's the real entrepreneur. Everyone else, are hopefuls or wannabes. And so I think you have to go back and say ability and incentive, right? You got to have people who have the ability, and you got to have people that have the incentive to pursue and undertake those risks. And I think there's a lot that can be done to improve both. The human capital side of things, to some extent, on a non-for-profit basis, just as a charitable endeavor, but also on a for-profit basis. I think there's a world of opportunities to educate the currently undereducated, and through education make them better apt to undertake challenges in a way that gives them a chance to succeed. But also the incentive model is paramount, and I think fundamentally one of the reasons why here in the United States entrepreneurship is such an integral part of the culture is because the ecosystem supports risk-taking, and individuals by and large trust in the rule of law, and they are, even though there are many industries extremely regulated where you don't know and you have what the outcome might be, or your barriers to entry are huge. By and large, this is an unregulated, free market type of environment when compared to other parts of the world. So I think fundamentally it isn't just about the individuals, but it's about the ecosystem around that individual, and how does that risk-reward equation pan out, and everything that we can do to lower the barriers to entry, to give them certainty that the fruits of their labor will be theirs as opposed to forcefully shared, and several of these other things such as rule of law. It's essential to stimulate those potential entrepreneurs to actually become entrepreneurs, and then the windfall of benefits that comes from that, because when people tap into their ingenuity and try to solve problems that they identify, we all benefit.
And I would add to that, in that thinking about entrepreneurship or even small businesses, there are different segments. There's the high-growth tech entrepreneur that we all hear about, and we wish we would have thought of Instagram or Facebook or what have you, but that's not the majority of America. 80% of entrepreneurs in America are actually solopreneurs. They're a single individual making, and I would not discount them, because they are the ones that are out there, hustling on the street corner. They're the vendors that we see. They're feeding their families on these small businesses. The problem is, and the question is, in part of this conference, the question is, how do those individual or very small businesses, how do they grow? How do they create more scale and capacity? There's a study that's done, and I hate that I'm forgetting the name of the organization, but they said if 1 in 3 small businesses in this country actually created an additional job, then we'd be at full employment. So I think we haven't paid enough attention to the solopreneurs and the small business owners, and probably too much attention on, the big, whatever technology exit, which we hope happens in the case of my portfolio as well. But we're really excited from a technology standpoint. It's how do we support and enhance the business acumen and drive revenue for these solopreneurs? How do we aggregate information? How do we create processes for inventory management when they can't afford to store inventory, so they're paying higher costs when they're buying inventory day of? So I think there's a large opportunity to look at this large population of entrepreneurs, the largest in America, these sole entrepreneurs, and figure out ways to enhance that business growth.
No, and Bruce, from an emerging market standpoint, the other dimension of this is the supply chains of larger companies who employ millions and millions of micro entrepreneurs, either in distribution or in manufacturing. And from an inclusion standpoint, the supply chain companies have a vested interest in the success and the health and well-being of their supply chain. So they're a good leverage point for thinking about how to bring products and services and knowledge and capability building to their millions of micro-entrepreneurs, a large majority of which are women. And so when we think about how we're going to accelerate financial inclusion, working through the supply chain companies to get to the millions of entrepreneurs, whether it's credit to expand their business or access to health insurance or savings for retirement, that's a very fruitful area of focus, which combines the point about entrepreneurs but puts them in an environment where it's more structured and the risk is mitigated and so forth.
I think we are running out of time, so I'd like to end there with these really thought-provoking remarks, and really thank the panelists for being here today and sharing with us their experience, their expertise, and their knowledge on this really important topic. So thank you very much.